Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Stocks, Basics and Key Definitions. Ever wondered what stocks really are and why they're so important? Stocks are vital to the financial markets and can be a key part of building wealth. In this video, we'll break down the basics, including what stocks are, how they work, and why they matter. You'll get a clear understanding of terms like shares, dividends, and market value. Whether you're a newbie investor or looking to brush up on your knowledge, this video is for you. Let's make sense of stocks together. Understanding stocks. The basics and definitions. Investing in stocks might sound confusing at first, but it's easier than you think. Below, we'll cover what stocks are, why they matter, and the types you can invest in. Definition of stocks. Stocks represent ownership in a company. When you buy a stock, you buy a piece of that company. Think of it like owning a slice of pizza. The more slices of pizza you own, the bigger your share of the whole pie. Stocks are often called shares because they represent a share of the company's profits and assets. Being a shareholder means you have a claim on part of the company's earnings and assets. This also means you have some say in how the company is run, especially if you own a large number of shares. Types of stocks. There are two main types of stocks, common stocks and preferred stocks. Each type has its own features and benefits. Common stocks. Common stocks are the most popular type of stock. When people talk about stocks, they're usually referring to common stocks. These stocks give you the right to vote at shareholder meetings and receive dividends. Dividends are payments made to shareholders from the company's earnings. Voting rights. Owning common stock means you have a vote in key company decisions. Dividends. These are often paid out quarterly and can change based on company profits. Preferred stocks. Preferred stocks are a bit different. They don't usually come with voting rights, but they offer other benefits. Fixed dividends. Preferred stocks often pay fixed dividends, meaning you get the same payment every period. Priority over common stocks. If the company goes bankrupt, preferred shareholders get paid before common shareholders. Each type has its pros and cons, so it's important to understand what you're getting into. If you want to have a say in the company and possibly earn more through fluctuating dividends, common stocks might be for you. If you prefer stable income and less risk, preferred stocks could be a better choice. By understanding these basics, you're well on your way to becoming more confident in your investment choices. How do stocks work? Stocks can seem complicated, but they play an essential role in the financial market. They represent ownership in a company and a claim on part of that company's assets and earnings. To understand how stocks work, let's break down some key aspects. Initial public offering, IPO. An initial public offering, IPO, is when a company first sells its stock to the public. This is a big step for a company because it moves from private ownership to public ownership. When a company goes public, it can raise a lot of money by selling shares. This money can help the company grow and expand. An IPO also gives the company a higher profile, which can attract more investors and customers. Stock exchanges. Stocks are traded on stock exchanges like the New York Stock Exchange, NYSE, and NASDAQ. Think of these exchanges as large supermarkets where stocks are the items for sale. Here, buyers and sellers come together to trade stocks. Stock exchanges play a critical role by providing a platform. They offer a place for buying and selling shares. Ensuring fairness. They make sure trades are done fairly and follow the rules. Offering transparency. They provide information about the prices and availability of stocks. These exchanges have working hours, and most trading happens during these times. The prices of stocks can change based on supply and demand, news, and other factors. Buying and selling stocks. Buying and selling stocks involve a few steps, and this is where brokers come in. A broker is a person or a firm that buys and sells stocks on behalf of investors. Brokers have access to the stock exchanges and can make trades for you. Here's how you can buy or sell stocks. Open an account. First, you need to open a brokerage account. This is an account where you can hold your stocks. Deposit money. Transfer money into your brokerage account. Place an order. You can place a buy or sell order for a stock through your broker. There are different types of orders, such as market orders, which buy or sell at the current price, and limit orders, which buy or sell at a specific price. Execute the trade. The broker will execute the trade for you on the stock exchange. Confirm the trade. After the trade is executed, you get a confirmation showing the details of your transaction. Buying and selling stocks can be exciting but also comes with risks. Prices can go up or down, so it's important to do your research and perhaps consult with a financial advisor. Understanding how stocks work can help you make better investment decisions. Whether you are buying shares in a new IPO or trading on a major exchange, knowing the basics will give you more confidence in your choices. Key stock market terms. Understanding the stock market can be confusing. There are many terms that can sound like another language. Let's break down some of the key stock market terms you need to know. Market capitalization. Market capitalization, or market cap, is a simple yet vital term. It's the total value of a company's shares of stock. To calculate it, you multiply the company's stock price by its total number of outstanding shares. Why does market cap matter? It helps investors understand the size of a company. Companies are categorized as large cap, over $10 billion, mid cap, $2 billion to $10 billion, small cap. Under $2 billion, large cap companies are often considered more stable, while small cap companies might have more growth potential but carry higher risk. Dividend. A dividend is a portion of a company's earnings distributed to shareholders. It's a way for companies to share profits with their investors. Dividends typically get paid quarterly, but some companies pay them monthly or annually. Why are dividends important? Income. They provide a steady income stream. Reinvestment. Investors can reinvest dividends to purchase more shares. Think of dividends as a thank you gift from the company for your investment. Stock split. A stock split occurs when a company increases the number of its shares to boost the stock's liquidity. For example, in a 2-for-1 stock split, every share you own becomes 2 shares. While the number of shares increases, the stock price is adjusted so the overall value of your investment remains the same. The impact of a stock split includes affordability. Lower share price makes it easier for new investors to buy. Liquidity. More shares improve trading volume. Understanding these risks can help you better navigate the stock market. Remember, always do your research and never invest more than you can afford to lose. By being aware of these risks, you're one step closer to making smarter investment choices. Understanding stocks is crucial for anyone looking to invest in the stock market. Stocks represent ownership in a company and entitle the holder to a portion of the company's profits and assets. Here's a breakdown of the basics and key definitions to help you grasp the fundamentals of stock investing. Stocks, also known as shares or equities, are issued by companies to raise capital for various purposes, such as expanding operations, funding new projects, or paying off debt. When you buy a stock, you become a shareholder, owning a fraction of the company proportional to the number of shares you hold. There are 2 main types of stocks: common stocks and preferred stocks. Common stocks are the most widely traded and grant shareholders voting rights at shareholder meetings, typically 1 vote per share owned. These stocks also entitle shareholders to dividends, which are portions of a company's earnings distributed to shareholders, though dividend payments are not guaranteed and can fluctuate based on the company's performance. Preferred stocks, on the other hand, generally do not carry voting rights but offer a fixed dividend. This fixed income aspect makes preferred stocks similar to bonds. In the event of a company's liquidation, preferred shareholders have a higher claim on assets than common shareholders, though they are still subordinate to debt holders. The stock market itself is a collection of exchanges where stocks and other securities are bought and sold. Major stock exchanges include the New York Stock Exchange, NYSE, and the NASDAQ. Stocks are traded through brokers, who act as intermediaries between buyers and sellers. These transactions can take place on the exchange floor or electronically. Key to understanding stocks are a few essential metrics and definitions. Market capitalization, market cap. This represents the total market value of a company's outstanding shares of stock. It's calculated by multiplying the current stock price by the total number of outstanding shares. Market cap helps investors gauge the size of a company and compare it with others. Price to earnings ratio, P/E ratio. This is a valuation metric that measures a company's current share price relative to its per-share earnings. A high P/E ratio might indicate that a stock is overvalued, or it could suggest that investors expect high growth rates in the future. Dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's calculated by dividing the annual dividend per share by the price per share. Dividend yield helps investors understand the return they are getting from dividends alone. Earnings per share, EPS. This indicates a company's profitability and is calculated by dividing the company's net income by the number of outstanding shares. A higher EPS indicates greater profitability. Beta. This measures a stock's volatility relative to the overall market. A beta greater than 1 indicates that the stock is more volatile than the market, while a beta less than 1 means it is less volatile. Understanding these basics and key definitions can help you make informed decisions when investing in stocks. Stocks can offer significant growth potential, but they also come with risks. It's important to conduct thorough research, understand the fundamentals of the companies you invest in, and consider your risk tolerance and investment goals. Whether you're looking for growth stocks, value stocks, or dividend-paying stocks, knowing these basics will provide a solid foundation for your investment journey. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.